Welcome to another video of time value of money. In this video, we will look at the concept of multi-period compounding. Most of the discussions in the videos for time value of money assume that cash flows occur once a year. This is called annual compounding because at the end of every year, the interest is getting compounded. However, in practice, cash flows could occur more than once a year. For example, banks pay interest semi-annually. Home loans, student loans, and auto loans require monthly payments, etc. The banks, brokers, and other financial institutions quote the interest rate on an annual basis and is known as nominal interest rate or annual percentage rate. So, nominal interest rate or annual percentage rate, APR. So, what is nominal interest rate or annual percentage rate? Suppose you invest 100 rupees in a bank with interest rate being 10% a year, and that the bank will compound semi-annually. So, deposit amount is 100 rupees. Interest rate is 10% per annum and compounding is semi-annual. So this 10% per annum, this is the nominal interest rate. Let's call this nominal rate as number 1. Now let's move on to period and periodic rate. So let's first understand what is meant by period. I'll take a different example here than what I had taken in number 1, just so we understand this clearly. So let's say the total time frame given to us is 2 years and the compounding is happening on a monthly basis. So monthly compounding. So in this case, there will be 2 multiplied by 12 equal to 24 periods in consideration. So basically this is number of years and this is periods per year. So we can say that number of periods is equal to number of years multiplied by periods per year. Now in our example number 1, if this deposit is being done for 1 year, then the number of periods is equal to, so this is 1 year, and since the compounding is happening semi-annually, so in 1 year there are 2 periods, so 1 into 2, so 2 periods. So we understood the concept of period. Now let's move to periodic rate. Now as discussed earlier, The rate charged by a lender or paid by a borrower per period is known as periodic rate. It can be rate per year, per 6 months, per quarter, per month, etc. So the periodic rate can be defined as nominal interest rate or APR divided by number of compounding periods per year. So in our example here, the periodic rate is equal to the nominal interest rate, which is 10, divided by the number of compounding periods per year, which is 2. So this is 5%. So we have seen the nominal interest rate, we have seen the periodic rate. Now let's move to the third type of rate, which is the effective annual rate or effective interest rate. So in our example, since the compounding is happening every 6 months, the bank will first calculate interest on your deposit of rupees 100 for the first 6 months at 5% per period and add this interest to your principal. Now on this total amount accumulated at the end of the first 6 months, you will again receive interest for the next 6 months at 5% per period. So for the first 6 months, interest is equal to 5% of 100, which is 5 divided by 100 into 100 equals to 5 rupees. Now the principal at the end of 6 months becomes $100 plus 5 equals to 105 rupees. So now for the next 6 months, you'll earn interest on this 105 rupees. So interest equals to 5% of 105. So 5 divided by 100 into 105. And this will come out to 5.25 rupees. So at the end of 1 year, the total accumulation of interest will be equal to 5, which is this amount, plus 5.25, which is this amount, which is equal to 10.25 rupees. However, if interest were compounded annually, you would have received interest equal to 10% of 100, which is equal to 10 divided by 100 into 100 equals to 10 rupees. This is when compounded annually. So the total amount at the end of 1 year would have been 100 plus 10, which is 110 rupees. So basically, you received more interest overall under semi-annual compounding because you earned interest on the interest earned during the first 6 months. And you will get still higher amount if the compounding is done quarterly or monthly. So in this example, 10% is the nominal interest rate, while 10.25% is the effective interest rate. So nominal is 10%, while effective interest rate is 10.25%. Now, a point to be noted is that if the compounding period was annual and if the annual interest rate was 10.25%, then the interest amount would be 10.25 rupees. So if we know the nominal interest rate and the number of compounding periods per year, then we can find out the effective interest rate by using the formula 1 plus I to the power n minus 1